Signs of stress in the trillion-dollar U.S. auto market indicate an impending collapse as storm clouds gather in the economic and financial landscape. Auto loan delinquencies with borrowers behind by 90 days or more have surged to levels not seen since the 2008-9 financial crisis, putting the entire automobile financing market at risk of a massive default wave. Experts are alarmed by the state of the car loan sector, warning of a brewing financial crisis that could devastate the U.S. economy. In today's video, we expose these concerns and kindly ask for your support with a thumbs up and subscription. Speculation has grown for months that auto loans could trigger the next financial crisis. Cars hold cultural significance and are vital for work, school, and community involvement. However, new auto credit data suggests that the loans taken to buy cars could lead to a significant downturn in 2023. The world's leading auto market has faced deteriorating conditions. Auto loan delinquencies have surged for borrowers under 30, surpassing previous records. Federal Reserve data shows that delinquent and seriously delinquent auto loans have reached levels not seen since the global financial crisis, surpassing $23 billion and $8 billion, respectively. The report indicates that an increasing number of buyers are struggling to keep up with auto payments, putting a record 7 million Americans at risk of vehicle repossession due to being 90 days or more behind on their loans. Millennials carry the majority of the outstanding auto loan debt, and 1 in 3 Americans between 18 and 30 claim that their car payments exceed 20% of their after-tax income. Unfortunately, the outlook for these borrowers is bleak. Inflation has driven up consumer goods prices, eroding their ability to make car payments. Rising interest rates compound the issue, making credit card debt more expensive, particularly for young borrowers. Additionally, the resumption of student loans in summer 2023 adds further financial strain. According to a February Fed survey, young Americans and low-income individuals anticipate difficulties in making payments in the coming months. Those under 40 and earning less than $50,000 a year reported a nearly 1 in 5 chance of missing a minimum debt payment within the next 3 months. Official agencies warned in March about the heightened expectation of debt delinquency for individuals under 40, the strongest since the spring of 2020, when 14 million people lost their jobs during the initial pandemic shutdowns. This situation raises concerns of a potential massive wave of defaults due to the increasing reliance on auto loans. By the end of 2022, the outstanding auto loan debt across the nation reached an astonishing $1.55 trillion, more than double the amount from a decade ago. To put it differently, auto loan debt averaged $4,800 for each person in the country. At the state level, Texas ranked first in auto loan debt per capita. Federal data also reveals that Texans with a credit report had an average car loan of $7,300 by the end of 2022. Following Texas were Louisiana, $6,500, and Georgia, $6,100. Across the country, borrowing has surged due to high prices of new and used cars, resulting in larger loans. New car loans averaged nearly $40,000, a 25% increase in 3 years. Used cars saw an increase from $18,000 to $28,000 during the same period. This has strained many household budgets, making it challenging for most to keep their car payments below 10% of their take-home pay, as advised by financial advisors. For instance, a couple earning the median household income for married couples would spend 16% of their after-tax income on payments for 2 new cars with average loan values. Owning 1 used and 1 new vehicle would cost them 14% of their take-home pay. On the other hand, individuals living alone would allocate 23% of their after-tax income for an average new car loan and 17% for a used car. Typically, a car loan takes precedence as the primary payment for individuals since owning a vehicle is crucial for commuting to work. In many areas, a car holds a higher priority for payment than even a home mortgage or rent. Mike Kagwin, a senior director at Fitch Ratings, emphasizes that a car loan is the top financial obligation, as without a car, it becomes challenging to commute to work. For low-income and working-class Americans, rising car loan delinquencies signify worsening economic conditions. Satyan Merchant, the senior vice president of TransUnion, adds that inflation and interest rates contribute significantly to the financial difficulties faced by many Americans. However, rising unemployment poses an even greater threat. Approximately 80% of defaults result in car repossessions each year. The auto loan market in general lacks the same level of restrictions placed on mortgages after the financial crisis. This requires borrowers to be more cautious when taking out auto loans, as lenders often offer loans that they know borrowers cannot afford. Predatory lending practices and limited transportation options further contribute to households being trapped in debt with limited solutions, according to Payal Chandra, president of the liberal U.S. Public Interest Research Group. Repossessing a car has become quicker due to technology and state laws. Certain vehicles are equipped with devices that prevent them from starting if a payment is missed. Additionally, tracking license plates and geolocating cars has become easier, making repossession more efficient. The executive notes that repossessing a vehicle is much simpler than foreclosing on a home. Moreover, borrowers who took out car loans in the past 2 years face the challenge of accelerated depreciation. As prices plummet nationwide, these borrowers may find themselves owing significantly more on their loans than their vehicles are worth. Financial analysts claim that many lenders are disregarding red flags associated with applicants struggling to repay their previous auto loans. This issue is exacerbated by stagnant wage growth in the U.S. over the past 24 months. It puts immense pressure on households as they strive to strike a balance between expenses, income, and savings. Andrew Schmidt, a scholar from the University of California, Berkeley School of Law, argues that state officials, lawmakers, and regulators are not intervening in the car credit market to curb the issuance of subprime loans. Since the Great Recession, the number of car loans issued in the United States has reached an all-time high. Lending to individuals with low credit scores and high risks of default has sharply increased. Some lenders price cars significantly higher than their Kelley Blue Book value, allowing them to profit from down payments and initiation fees alone. Subprime loans come with exorbitant interest rates, occasionally surpassing 30%. Consumers taking out subprime loans are already in dire financial situations and unable to qualify for conventional car loans. Faced with limited bargaining power and an urgent need for transportation, they have little choice but to accept abusive terms from lenders. While lenders benefit from defaults, some borrowers spend years paying off loans for vehicles they only used for a short period. Lenders employ aggressive collection tactics, including lawsuits and wage garnishment, to recoup outstanding loan balances. Some subprime lenders even have in-house attorneys to handle the high rates of default. However, the increased potential for mass default of subprime auto loans can send shockwaves through the financial system, akin to the mortgage crisis in 2008. Schmidt expresses concerns about the potentially disastrous consequences for the economy. Risky lending practices create a surge in demand for used cars, leading to price inflation, according to Schmidt. Lenders have the incentive to originate loans that are likely to default since they still profit from the process. Similar to the housing crisis in 2008, a scenario of widespread defaults would flood the market with repossessed cars, causing a collapse in used car prices, followed by new car prices. As loan-to-value ratios increase, borrowers on the brink of default would be unable to refinance, resulting in another wave of repossessions and further price declines. For low-income Americans, having a car repossessed could result in the loss of employment, overwhelming debt, and even disqualification from public benefits. Consequently, the auto market crash is expected to disproportionately impact the most economically vulnerable households. Schmidt warns that without significant intervention, the subprime auto loan bubble is poised to burst. Similar to past financial crises driven by reckless lending and speculation, this crisis could escalate to unimaginable proportions. The domino effect is already underway in the financial world, with the automobile market potentially being the next sector to face significant challenges. We value your thoughts on this matter and look forward to your comments below this video. Thank you for watching.